Dear students, welcome you all to session 11 video of the chapter Financial Statement Analysis, Financial Management 6th semester BCom of Mangalore University. The chapter Financial Statement Analysis. In this session, let us understand the meaning of financial statements. We know that financial information is the basis for financial planning, analysis and decision making. Financial information is required to predict, compare and evaluate a firm's earning ability. This information is required in taking investment decision or financing decision. So the financial information which we require is contained in the financial statements. So what are these financial statements? Financial statements are the basic formal annual reports through which the management communicates its financial information to owners, the investors, the government, employees, tax authorities, general public, etc. So these financial statements are prepared from the accounting balances available in the trial balance. These are actually the final product of the accounting process done during the accounting period. Now, the financial statements include the profit and loss account and balance sheet. Profit and loss account, it's a financial statement which is prepared to know the financial performance. That is for the purpose of ascertaining the profit or loss of the firm. The earning capacity and the potential of the firm are reflected in the profit and loss account. The profit and loss account, it actually reflects the results of the operations of the business for a period of time. So it actually explains what has happened to a business as a result of operations between the two balance sheet dates. For this purpose, the revenues are matched with the cost in order to ascertain the net result, that is net profit or net loss. We have the balance sheet as the most significant financial statement. So balance sheet is actually a statement of assets and liabilities which shows the financial position of an enterprise on a certain date. It actually indicates the financial condition or the state of affairs of a business at a particular moment of time. It represents the assets owned by the firm and the claims of the owners and the outsiders against those assets. And the balance sheet actually communicates the information about the assets, liabilities and the owner's equity. When we speak about assets, assets are the valuable economic resources owned by the business firm. We classify it into current assets and the fixed assets. Current assets, that is the liquid assets, are those resources of the firm which are either held in the form of cash or which are expected to be converted to cash within an accounting period. And fixed assets are in long term in nature, that is they are held for periods longer than an accounting period. They include tangible fixed assets like building, machinery, furniture, etc. and also intangible fixed assets, that is the patents, copyrights, trademarks. So assets are classified into current assets and fixed assets. Current assets are for a shorter period of time that can be converted into cash within an accounting period, and the fixed assets are for a longer period, and these are actually classified into tangible fixed assets and intangible fixed assets. And the firm's obligations, we call it as liabilities. Liabilities actually represents the debts payable by the firm in the future to the lenders as well as the creditors. So liabilities also be classified into two types, the current liabilities and the long-term liabilities. Current liabilities are the debts which are payable within an accounting period, and usually we pay it out of the current assets or out of the earnings of the firm. And long-term liabilities are the obligations or debts payable in a period greater than an accounting period. And we also have the owner's equity, or simply we call it as equity. It is actually the financial interest of the owners in the business. The owner's interest is actually residual in nature. It actually reflects the excess of firm's assets over its liabilities. Now, the owner's equity, it actually represents the accounts or the funds invested by the business, but over a time it changes due to the earnings of the firm and their distribution. That is, the firm's earnings do not affect the creditor's claims, The owner's equity will increase when the firm makes earnings and retains a part of it. If the firm incurs losses, what happens is the owner's claim will be reduced. So in case of business firm, we call it as a shareholders equity or shareholders funds, which is actually the paid up share capital as well as the reserves and surplus, which is the retained earnings, which represents the undistributed profits. So the balance sheet contains all these information which actually represents the financial position of a business enterprise on a certain date. Now, the financial statements are used by the shareholders, the owners of the business firm, the management, the employees in the business organization, the government, the tax authorities, banks and financial institutions, the competitors, customers, investors, the creditors and the general public. Thank you.